Have you ever wondered why, in your trading, your P&L consistently goes down but never up? It's most likely due to the fact you don't have the right risk management for you specifically. Hi everyone and welcome to the Beginner Trader series. Today's topic is risk management. Before we go into the chart to see how this is implemented, I wanted to emphasize that this is the single most important concept to know and always use. It will help you when you're too scared to look at the price and hoping it will go in the direction you want, and it'll be your best friend that you can high five for not blowing you up. So what is risk management and how do we use it? By definition, it is identifying and accepting the potential loss of capital. Essentially what that means for a trader is having a stop loss so you can minimize the impact a trade can have on your account. So over time, your account balance will look like this chart. Or maybe this one when you get better. Because no matter what, money will be lost some days. But being able to accept it for a trade and move on is just one big hurdle to get over. Here are some things to watch out for when seeing how you respond to loss. At the end of the trading day, are you happy with the loss that your risk management brought you? Hooray! Or instead, after a loss, do you up your position size or switch to the opposite direction when the direction you want isn't working? Or chase a trade because you're frustrated because you missed out? Or do you fight the trend because in your mind the price has already gone so far in that direction that it just can't go up anymore, only to see it keep going and never come back? These are just a few examples, but the general term for this is revenge trading, and often it leads to a downward spiral where after doing this multiple times and throwing risk management out of the window, at the end of the trading day, most people are in front of their computer screens realizing what they've done full of regret. So how do we manage our money risk correctly? In the trading world, risk management is often coupled with another term, risk to reward. By simple definition, it's the accepting potential loss for the potential of gain. So let's say you were willing to risk $1 for the chance to get 3. Let's say another trade, you were willing to risk $100 for the chance to get 300. In both instances, the risk to reward, or RR, would be 1:3, represented by a ratio, because in both instances, the potential to gain is 3 times the potential risk. So why is this important? Because we want to take as many trades as possible with the right risk to reward ratio for our emotional psychology. Let's say you make 10 trades, risking $1 each time for the potential of 3. If you only win 3 of them, you would still be up at the end of the trading session. 3 wins equates $9, 7 losses equates to $7. At the end, you will still come out net positive with $2. People like me will show you the numbers and it all sounds good. But the real question is whether this level of risk management is good enough for you. Can you really psychologically stomach losing 7 times out of the 10 times you place a trade? Maybe scalping is more your speed, where the RR might be closer to 1:1, but the probability of success is 60%. But psychologically, winning more than you're losing might be good for you. Doing the math again. 6 wins equates to $6. 4 losses equates to $4, giving us the same total of $2. Most traders will tell you that you should get a risk to reward ratio of 1 to 1.5 or more, and that is great advice. But everybody has to start somewhere to understand themselves psychologically as a trader. Beginner traders can learn to eventually have a better RR when they can accept loss better. And I believe this is equally, if not more important to understand. So, higher probability, smaller risk to reward, or lower probability, higher risk to reward. Starting with one of these as a beginner trader, eventually you will build yourself up as a trader and figure out what works best for you in terms of risk management of your capital, emotion, and your psychology. And getting to that point where you can balance all 3 really well is when you'll truly become a consistent and successful trader. So now let's go to the charts and see this in action. Here, I see the price is moving toward a level that I think would be interesting to short to the downside. As it ticks above the price level that I find interesting, I press the sell button on the top left-hand corner. So why this price? Drawing in my trend line might make this easier to see. Notice before this point, there are 3 price rejections off of this trend line following the break of it. so we have some confidence that the price would temporarily do the same here. Now there are two stops we can use: the recent local high using our trendline criteria, which is $3.5 away, or in keeping with our 1-to-1 risk to reward ratio, we can do $5 away and a $5 target. To start, we're just going to use $5 as our target. So I'll add a limit order at $3,794.25. If you don't see your order line, double click your candlesticks and go to the trading tab and make sure orders and extended price line for position and orders are checked on. I also wanted to note that currently the time is 8:30 Eastern Standard Time on Thursday, October 27th, 2022. Next, we're going to add our stop loss $5 away to keep our risk to reward 1-to-1. Now we just sit back and let the trade unfold itself. Since we shorted the contract, as the price moved down, our P&L went up. Then, as the price hit our target $5 away, I closed the position. So, as you can see, using only our trendline criteria and simple risk management, we can already start making good trades. If you found this video interesting or useful, please give this video a like to support the channel and future videos. Subscribe to the channel to keep up to date on the newest videos and analysis I will upload. See you in the next one.